you got ahead of the so-called growth scare. You thought we were going to get something like that, undercutting market averages. That did happen. Give me your assessment of the correction and I guess what you see as a potential impact here in terms of the portfolio effect.
Yeah, thank you for having me. I think that's the number one question we're fielding from clients right now, and it's an obvious one, is, we've had a 10% correction. This is a much more, it's not like an atypical event, but it's much less common than like these 5% pullbacks we've been suffering through over the last couple of years. And so the big question is this the bottom? Should we be de-risking down here, or should we be buying the dip? And to us, like when you zoom out and you look at history, there's been 52 of these things, and if of these corrections. And the major determining factor on whether we go lower from here, significantly lower, is whether the economy is going to hit a recession in the next 6 or 12 months. So that's where we focus a lot. In our basic indicators, just to be clear, we don't see a recession. The deficit is still pretty large. We've seen private credit ticking up. The credit spreads have been really well behaved during this 10% decline, which is basically what you see if we're not hitting a recession during a correction. And so for the most part, and we don't see early cycle, job losses, what we expect. So for the most part, all those things are in place. But the thing you alluded to that worries us, what we always wonder what could be different this cycle, it's this, we've had wealth effects, such a positive impact on the economy. The upper strata of consumers have carried this economy. That's on the back of asset price inflation. And now this 10% pullback, when you think about it, with households so overweight, equities has resulted in a 12% of equivalent of 12% of GDP wealth shock to household net worth. So the 10% corrections are pretty common, but these wealth shocks are pretty rare. It's only the 13th one of this magnitude we've seen. In half of these cases, the economy does end up in recession. So if you're looking for something to be worried about, this is where we're really digging in right now.
It's interesting because if you just look at the aggregate value of equities, and therefore, somebody owns all the stock, so that's, that's where the wealth effect is coming from. We're back to like last summer's levels, right, in absolute terms. You think that kind of round trip back to where we were 6 or 8 months ago is enough, either psychologically or even by the consumer balance sheet, to change spending behavior a lot?
I think so. The short answer is not enough to put us in a recession. That we're not there yet. The other factor when you think of these wealth shocks, just to be totally transparent on the data, is because stocks have become a larger, increasingly larger share of household net worth over these years. These things have become a little more common. My stats going all the way back to 1950, but we saw one of these in 2022 without a recession. We saw one of these in 2018 without a recession. And so it's important to flag that. I think the duration of how long we stay down here and how quickly we recover from these lows in the volatility, that's going to be really determine how much retrenching we get from the consumer. But we're at a different place in the cycle, and I do think that some of the lower strata is already in a bit of a recession. And so if you get this high income consumer pulling back, it could be really bad for the economy. So yeah, we're watching it, but not there yet.
And just in terms of what your work and what your gut and everything says about where we are in this correction process, I know you were also anticipating potentially come April, tax payments having to be made after we had big upside in equities last year, and that could be another drag. Does that just mean we're going to stay choppy and keep testing these lows?
Yeah, I think that, number one, you have to be really clear with your clients and with yourself. So we have a 10% pullback. I think you need to start having an offensive mindset, given the fact we don't see a recession at this point in time. Offensive mindset means that if you're underweight, get to benchmark weight. But on the other hand, we're not ready to go overweight equities again. We came into the year overweight equities. Like you said, we downgraded in early February, and we're happy sitting here at benchmark weight after this 10% correction. I do think that so far the lows are in for the next 2 weeks in the month of March. But I think the month of April is going to be, potentially we revisit and break through the lows we saw in March. So if you want to get overweight equities, to me, I think you wait till April, wait till we're through this liquidity drain that we see, and wait for a fat pitch on the sentiment indicators and some of the other things that we watch. So that would be my advice till April.
All right. No, we appreciate it, Warren. Thanks very much.